We are Team Revamp. We'll be discussing the purchase of distressed mature assets to revamp. The just problems that we discussed were obviously the inherent risks of the oil and gas industry in general, the reworking and production risks that are associated with what we want to do, and the various problems that are associated with working with mature wells. We're not sure how depleted a reservoir is once we get there. It's obviously an old field, so they've been working on getting oil out of it for a while. And antiquated well technology, some of these wells in these areas have been producing since the late 70s. So obviously technology has changed a lot since then. And with that comes structural integrity, casing and the formation itself. We run some risks there and address those problems. In two of the areas we've worked with, Kansas and Texas, there are added regulatory costs due to migratory birds and things of that nature. Also, there's plug and abandonment issues and responsibilities that come along with buying old wells. And it was just we worked together to figure out how to manage all of these added risks while maintaining a profit. The approach we took is we wanted to develop two portfolios. We wanted to purchase 10 mature wells, 5 wells per field. And our purpose was to rework and apply newer technologies to these mature wells, and in hopes of increasing production. Obviously, more oil is more money, so that's our main focus. Our various risks are increased production volumes and reworking issues where we can't guarantee either of those, and we can't guarantee a set cost. The constant variables that we used were we had a set oil price, we had a baseline acquisition cost that we used, and we did not consider huge decline curves just because of the nature of these shallow fields. They don't have a typical decline curve like these horizontal fields do. It's not a steep hockey stick. They have a longer life, and we did not consider salvage costs because of that also. As for modeling, as I mentioned before, our main purpose here is for oil production increases. So we did an NPV for each well on a 5-year cash flow basis with no terminal value. And each portfolio has different production trends. As far as assumptions, we assumed the inherent risk of the oil and gas industry. We had some constant variables that we talked about. So we had some proprietary data that we got for 1 year of operations cost, and we applied a growth rate on that and extrapolated that out for our model. Our oil price that we used, a lot of future estimates that we kind of trust were kind of hovering around the $70 a barrel mark, so that's what we used. And as I mentioned, we had a set acquisition costs, set reworking costs, drilling costs, and area well decline rates.
So taking a look at our deterministic and non-deterministic values, variables that is. So deterministic is going to be the proprietary data we have on intangible drilling and completion expenses, and then as well as acquisition costs for wells that already have a long timeline of average monthly production without a whole lot of variability. We used a constant discount rate of 10% when doing net present value, and then net present value itself, obviously, which we'll get to the data here momentarily, but finding that the Texas wells produced significantly higher NPV, did have higher drilling and completion as well as acquisition costs. That comes in route with having higher production values. Non-deterministic variables, hard to quantify production increases you can get from reworking or drilling offsets. So we didn't account for that when doing growth rates in our cash flows, as well as oil price fluctuation. We assumed 70. Obviously, futures are considerably below $70 a barrel now, but over a 5-year span, we assumed the safe route was to assume a middle level figure, and as well as regulatory costs. That's a changing environment. It's hard to account for increased regulatory costs on the upstream. Some of the challenges, so obviously inherent risks of oil and gas, a volatile industry with regulation, new regulations coming in on a yearly basis, lack of operational hands-on experience. So our ability to actually impact production can't be boiled down to turning wrenches. There's a certain extent where you're going to have to hire third parties to do your workovers, to do all your operational as well as to gather production. Differences in risk evaluations and risk thresholds, and also our operational expenses was one instance of a single annual recorded operational expense. And then we're building that, assuming that's going to increase at 6% year over year. So obviously, looking at statistics, having just one instance and assuming, even though that is an actual recorded expense, there's something that can be lost in extrapolating that. And then also lack of experience in specific oil fields. So don't live in Texas, don't live in Kansas, so don't have as much of the feel for what the oncoming regulations are going to be. Now looking at some of the quantitative on just our 5-year cash flow horizon. So year one is generally going to, across the board, is going to be a negative cash flow just because there's going to be a constant operational expense as well as that acquisition. And we looked at wells that the acquisition expense would be purchasing land and mineral rights and would be one lump sum number, as well as an acquisition cost that would be average monthly production times a certain variable. So there was quite a big spread in that. Now looking at our results for MPV. So all of these wells look to be good investments, but that is, with the understanding that we did not look at salvage costs, but average acquisition was about $288,000 and average MPV over a 5-year time horizon was $982,000. So significantly positive MPV. Two assumptions going in there is we're assuming that we can get an 8% year over year production increase, and that may be from drilling offsets, maybe from doing operational, but the reason we were confident in that number is that there's been a history, there's been a timeline of increasing production, as well as the operational expense that we used in this model did take into account offsets drilled. And then also we're assuming a 6% year increase in operational expenses, as I mentioned earlier. So some of our recommendations, clearly diversification is key. Looking at the Texas versus Kansas wells, Texas much more volatile month to month as far as production, but much higher production, where Kansas is lower month to month, but much lower volatility. Any ways we can cut operational costs, either by signing a larger contract for one third party to service all these wells. Obviously, the increased monthly and average daily volumes you can do by drilling offsets, and then trading assets instead of sinking cash into these. Obviously, it allows you to be a little bit more liquid with the pretty high month-to-month costs there. And then starting a fund with portfolios so we can share the risk to diversify that out amongst multiple parties. So some of the lessons learned, operational costs are obviously variable and subject to change. You're not going to have a consistent contractor servicing all your wells over a 5-year period. So whatever contract you have in place may very well need to be renegotiated. Diversification obviously is key. Looking at a relatively small sample size with only 10 wells in total, but with 5 being from one basin, 5 being from a contrasting basin, it was pretty clear to see the different volatilities inherent to those. And also plug and abandonment costs. We're not considering those after a 5-year time horizon, either selling these wells based on average monthly production, obviously selling at a higher cost than the acquisition, or purely moving along, but not looking at any sunk costs at the end of that time horizon. And just to reiterate, diversification and hedging, obviously key.
So for our further analysis, we thought about some things we would need if we wanted to kind of expand on this more. We would like some more information on the specific formations history. We don't know much about Kansas and Northern Texas. More info on decline curves over the long term. If there's been any major issues in the formation, structurally, regulatory, any sort of major issues that could be helpful. We're also thinking about comparing mature fields, shallow fields in other areas such as Colorado, different areas of Kansas, Wyoming, Oklahoma, some of the typical places that have mature, shallow, vertical, kind of old school fields that we could apply this model to. We also thought about scaling this on a bigger case, more portfolios, figuring out where that sweet spot of risk and reward would be. It's been a really interesting process so far, and thank you for your time.